Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we want to make the best investments that we can, so thank you so much for joining us. And on today's show, I'm excited to say that we have Ian Bezek back. Ian was on the show a few weeks ago. We had the first part of what has now become a two-part interview, and the first one had a lot of great reception, a lot of great feedback from that, so hopefully you'll be able to enjoy today's as well. And a few highlights for today. Ian is going to share with us the book that best represents his portfolio strategy, and it's not a book I would have expected. It's very interesting. He talks about why a 70% price decline in your holdings doesn't necessarily have to be a bad thing. He shares which company makes up more than 10% of his portfolio and why he chose to put so much money in that company, why he doesn't like Gilead or Apple as investments, and he goes on to tell us about how he uses stock screeners, what he looks for when reading annual reports, why he reads the risk factors, and when he looks at 10Ks, and all kinds of stuff, the tools he uses to study companies' income statements, the 3 filters every investment must pass through before he's willing to buy it, and parting advice for new and old investors. So again, another great interview with Ian Bezek. So thank you so much for joining us today. And remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com. On September 12th of this year, just a few weeks from now, the second online investing conference will kick off. This conference is fully online and will feature 3 top growth-focused investors, each sharing their current 2 highest conviction investments. All picks and research shared will be content that is normally reserved for their premium newsletter subscribers, and usually it costs hundreds or even thousands of dollars to get access to that content, but for a short time, you can get free access to the 2 highest conviction picks, and registration for the online investing conference is free up to September 7th, and the price jumps to $99, so be sure and get in now before that price increase happens. Headlining this year's conference is Brett Jensen, Cody Willard, and another speaker to be announced, so if you want to hear the highest conviction investment picks also owned by Brett Jensen and Cody Willard, go to onlineinvestingconference.com and sign up. That's onlineinvestingconference.com, or you can you can text the word join family. That's what I was looking for, to join family to the number 44222, and you'll get on our email list, and we'll send you an email shortly with all the information you need. But again, that's onlineinvestingconference.com, and hope you enjoyed today's interview with Ian Bezek. Well, hey, Ian, welcome back to the show.
I'm happy to be back.
Well, we had a great time with you a few weeks ago, and we ended up talking about a lot of things that I even didn't anticipate and thoroughly enjoyed, but which that means there's a lot of stuff we left, or I guess we could say stones we left unturned in terms of you as an investor, how you build your portfolio, how you go about valuing stocks, researching stocks, and everything in that regard. And so I'm excited to have you back today to pick up where we left off.
Yeah, definitely. Let's get back into it.
Well, where do you think is best to start? Would you prefer to start with how your overall portfolio philosophy, or would you rather start with actually your individual stocks and how you pick them?
Portfolio philosophy would be good.
Agreed. Let's do that.
So, and you asked me last time what books I found were interesting, so I'll name one that I find fits well with my view, awesome. Which would be Christopher Meyer, I believe is Meyer, I'm not sure. He wrote a book called 100 Baggers, which the name sounds kind of gimmicky. Oh, make 100 times on your money. But it's actually a very good book. He used a database to study stock returns back to 1962 and identified more than 300 U.S. listed companies that if you held the stock, never sold, and reinvested dividends, you made more than 100 times your money within the next 40 years. And the book goes through the different facets of what made these stocks great. Obviously, growth is the overarching thing. If you're a utility company and you're only growing at 2% a year, you're not going to make 100 times your money.
Right.
And then other important factors were how the company allocated its money. Share buybacks were very helpful. If the company paid huge dividends, that often was a drag in that if they're paying everything out to shareholders, they don't have enough to internally grow to the degree that would be necessary to hit that sort of target. But what I found more interesting is kind of the later part of the book where he's talking about why investors don't realize these huge gains, because they're very was a bunch of very ordinary companies we've all heard of, like Pepsi. It's not all biotech and crazy stuff, but it's companies we all know that are most of these companies. But people just don't have the patience to hold these companies. We make this error that we see something and, it's doubled, that's great, and we sell and we move on to something else. Or, the stock's been flat for the past year, I'm going to move to something that's has more action right now. And that was the big problem for people, is just they turn over their portfolios too much. And so when I buy a stock, I'm looking for something that I can hold for a long period of time. Because every time you make a transaction, you're taking the risk that you're going to do something to make your portfolio worse. And so I would reduce my turnover, buy good stocks that I'm confident holding for a very long period of time.
Well, tell me, so how many companies did you say he found since 1960 that were 100x returns?
It was in the 300s.
Okay, so 300 companies, and approximately how many are listed companies are there out there? Do you have an idea off the top of your head?
I know nowadays it's around 7,000 or 8,000. I believe it was somewhat fewer in the past. Okay. He did screen out companies with no revenues and with market caps of under 50 million. So it wouldn't be all like little gold mining or oil companies that hit a well and got lucky.
Right. So 300 out of about 7,000, that's still a pretty small group of companies. So even if investors had the discipline to stick with stuff, there's obviously still some important aspects to what you pick, of course. So that's fascinating. So what else?
However, I would say that it's 5%. It's 5% of the market. So if you build a diversified portfolio of 20 stocks that are kind of Buffett style stocks that you can hold on to that compound, there's a decent chance that you'll get at least one that is a tremendous performer.
Yeah. Of course, actually, this is slightly off topic, but you just mentioned Buffett style stocks. And I just read an article about how Berkshire Hathaway, I haven't been following, I don't own the company. I have not been following their price of the B shares, that is. I didn't realize, man, that stock has grown tremendously since 2013. I think it was in the 80s and now it's like in the 140s. That's tremendous growth for a company of that size and a company that's stable and quote unquote safe as an investment.
Yes, I believe that it was trading at a fairly low valuation on a price to book basis, and people have bid that valuation back up. Yeah. And so that's how it's recovered its value.
But even that's an example of a company that really could be considered pretty boring, because just for whatever reason, people I think of that as a boring company, because you don't think of it as one that's going to be massively growing, even though everyone talks about Buffett being one of the greatest investors ever and how his annual returns for decades have so far exceeded the markets. And yet we still think of Berkshire Hathaway as a boring stock. And there is an example of a company that has seen tremendous growth for its size and its relative safety in just a couple of years. But how many of us just pass it over because it seems boring?
Yeah. Actually, I have the list in front of me now. I'm looking, perfect. And there's so many of these that people would say, that's boring. Like Sherman Williams, they make paint, but it returned 800 times your money over 40 years. Or, let's see, Campbell Soup returned 150 times your money over 34 years. Caterpillar 261 times. You wouldn't think of that as a huge growth company. I mean, it's cyclical, but they dominate their niche. Colgate, 800 times return on your money since 1962 for toothpaste. It's pretty incredible.
That is remarkable. Well, so a lot of these 100 baggers were most of them over a period of decades? And obviously there were some that were shorter, but were more on the 40-year mark than on like the 5-year mark, for example?
Yeah, there were very few that were inside of 10 years.
Okay, actually, that makes sense. I'm
looking. It looks like there's only about a dozen that were inside of 10 years. Mm-hmm. An example of a faster one would be like Starbucks that took 21 years to be a 100-bagger.
But even that shows, again, well, you've already said this, but the value of patience. You know, if you hold on for 10, 20 years, which for most of us blows our mind, because you take whatever age you are now and you add 10, 20 years, it sounds like a lifetime from now. But that's kind of important when you're investing, to think in that kind of a time frame.
Yeah, and he noted that if you use stop losses, if you ever said, I'm going to sell if things go bad, it's down 30%, 40%, whatever, then you end up selling all of these stocks. He did a case study on Monster Soda. I guess it was Hanson's originally. But anyway, it was a 100-bagger. But if you held the stock over the course of its 100-bagger run, it made 3 50% declines and 2 70% declines. And so there would have been many points along the way where you would have been saying, I've made a mistake. I should have sold.
Wow.
At the top.
You said 2 70% declines?
Yeah.
Wow. That's crazy. Okay, but coming back to your portfolio strategy, I kind of went on a little rabbit trail there, which I'm prone to do. With your portfolio strategy, you mentioned this Christopher Meyer book, the 100 baggers, has been influential in building your strategy. How does that actually tangibly work out? You mentioned wanting to buy companies you're going to hold for a long time. What are some other aspects that have impacted you?
Yeah, it's the combination of factors that can lead to very long-term, durable returns. I want a company with a decent moat, something that's not going to be blown away with changing technology. But I also want something that's growing quickly enough that it can produce strong returns. Something like Colgate now, pretty much the whole world has toothpaste, and so their revenue has been flat for the past 5 years. And so it may have been a 100-bagger in the past, but it's not going to be a 100-bagger in the future when there's no revenue growth. Yeah.
For the sake of good and bad breath everywhere, I guess we hope that stays the same.
Yeah, exactly.
So what about how you build your portfolio? For example, do you have limits of like, hey, no company is more than 5% of my portfolio, or anything like that?
No limit on position size. I normally don't take large position. I only have one position that's larger than 10% at the moment.
Really? Okay.
But no hard limit.
Do you mind sharing what that is, or is that premium service reserved?
No, I can share. It's called Grupo Aval. It's the largest banking institution in Colombia and in Central America.
So, can you say it again in the ticker?
Sure. Grupo Aval, AVAL, and that's the ticker as well, AVAL.
Okay. What do you like so much about that?
That it's the largest bank in Colombia and in Central America, and it's a very underbanked part of the world. And so it has a very long growth runway. Only fewer than 10% of the population has a credit card now in the markets they serve. Fewer than 10% of the population has a mortgage. And so these very traditional banking products that are the bread and butter of the industry's profits just simply haven't been rolled out there to any great degree. The government, since the 90s, has pivoted to being a very free market, kind of U.S. capitalist-style government. They just signed a peace treaty with the long-running left-wing terrorists, and so that clears up that political risk. And so you now have an institution that can grow at 10 or 15% a year for the next 20 years. And they also pay a 5% dividend, so you get tremendous return on your capital while you're waiting for the growth story to play out.
No kidding. Well, how do you, with a company like that, obviously, when you get an international company in a less developed part of the world, obviously what we don't know can cause concern in terms of stability and everything else. You mentioned the signing of the peace treaty with the guerrillas, which makes things a little more stable. That's surprising that you have a position that size in a company in that part of the world. I'm not critiquing it all. I would not have expected that.
Mm-hmm. Yeah, the right now developed markets are very expensive, and so I'm eager to invest in places where I believe there's the potential for very strong returns. And I still have the majority of my portfolio in the developed world, but to the extent that I want to find stocks that are going to make me very wealthy over the course of my investing lifetime, I feel I need to look at some emerging markets now, because U.S. stocks, European stocks are very high starting valuations.
Sure. Yeah. No, that's great.
I've also lived in Colombia, so I have on the ground experience there in context.
Right. That's awesome. You're like an investor spy or something.
What's the term? A venture capitalist, I believe they've called it.
There you go. Perfect. I like that. Adventure capitalist. Nice. So about how many companies are in your portfolio right now?
In my I have two portfolios, one that I publicly share on Seeking Alpha that's not concentrated. That one has a lot of positions, but my primary portfolio is around 20 positions.
Okay. And how often, and obviously, I mean, you are very engaged in the markets, you're writing a lot, and yet you don't turn over positions very much in your portfolio. Like, how many times would you expect to make a buy or sell in a year? It can't be that many.
No. I believe I've made 2 sales this year so far.
Wow. Nice. So brokerages hate you.
Yeah, I don't pay a lot of fees.
Nice. What other details or aspects help shape out your portfolio and how you approach it?
What other aspects? I think one of the things that I focus on is trying to diversify, and not just in the sense that people always like to diversify, but trying to find whatever is cheapest in the market right now. And so I'm always looking through what's not been working lately. And that's how I stumbled on the Colombian banks, for example, last year. That market was down 70%. And so when you're looking at U.S. stocks that are at new highs all the time, you just say, I don't see anything to buy here. And so you want to go look where there's discounts. So I'm always looking to see where there's trouble in the world and see if there's anything I can buy there. And so I end up with a very organic portfolio because I'm always buying whatever is on sale. I'm not like constructing like this is what I want to own. I take whatever the market is offering on special at the moment.
So in that scenario you just described where a lot of companies in the developed world are very overvalued. So you're looking for value elsewhere. You found this company or this market that was down by 70%. Tell me about that process. Like, where did you start that you could even identify that? Were you just doing stock screens through your broker, or how'd that work?
Yeah, my process often starts with stock screeners. I would say to be careful with them because the data in there isn't always good. You don't want to buy just based off of a screener, but it's a way to generate ideas. And then you go read the filings based on something that's interesting. And if you know what you're doing in 10 or 15 minutes, you can look and say, oh, this is interesting. I should read the 10K, or, oh, this probably isn't any good. And then I'll study it more from there.
So what kind of things would you look for in a stock screen?
Let's see. Past growth is good. I want companies that are growing at least 5%. Because if they can't do that, they're probably going to generate mediocre long-term returns. High return on equity is a very good one because that's essentially return on equity more or less determines what return on investment you'll get over the long term. It's very correlated. Mm-hmm. And so you want to see that at least 10%, and ideally at least 20%. There's some sectors like banks where you're not going to get 20%, but at least 10%. Some dividend is nice. I'm young. I don't need dividends to live off of, but it indicates that management cares about shareholders, that they're not keeping all the money for themselves. And so as a sign of credibility, I enjoy seeing a dividend. It doesn't need to be high, but a willingness to return money to shareholders is something I really value.
Nice. So, like, you're not typically looking for the easy things like PE and things like that. Those aren't really high on your radar.
PE is helpful, but I think a lot of people view it as a magic kind of talisman to find stocks. Probably my biggest complaints, or where people get mad at me on Seeking Alpha, is when I'm saying I don't like Gilead or I don't like Apple. I don't like these stocks that have 9 or 10 PE ratios and they're shrinking earnings, and people are saying, oh, they're so cheap, but the market is pricing them fairly because it realizes that earnings are probably going to be 20 or 30% less 5 years from now than they are now. And so we're not going to pay much of a premium for that. And people are always saying, oh, these stocks are so cheap, you need to buy them. It's just, they're not going to produce good returns until earnings growth comes back.
Right. No, that's great. So
I would rather buy a stock at 18 times earnings that's growing earnings at 10% than buy a stock at 8 times earnings where earnings are shrinking at 10% like Gilead is.
Yeah. Well, I think I appreciate about that is you're looking beyond the easy pickings, because so often as individual investors, especially when time is limited and, we're in a hurry, you'll read something, you'll do a little bit of research, and we may not like to say this, but a lot of times we can end up cheating. And by cheating, I mean not doing all of our homework and not doing the amount of research we really should do before putting our capital at risk. And PE can be a quick and easy way to feel good about cheating, because like you said, hey, look, it's undervalued. It's a great company like Apple or Gilead. But when you look under the surface, you realize, and again, people may disagree, but there are very tangible reasons why people are valuing it where it is. They could be wrong. They could turn around in the future, but right now there is some reasoning there. I like that. What about, so once you have gone through the stock screeners, you've identified some companies you like. You said at that point you start looking at annual reports, quarterly reports. What are you looking for when you go there?
With the annual report, I start with the risk factors. I want to see what the company's lawyers have forced them to say, because that's the company faces legal liability if they don't properly disclose risks. And so there you'll find all of the potential bones in the closet in terms of what might go wrong with the company. And so that's the first place I look, and I see if there's anything unusual. If there's nothing unusual or nothing too troubling, then I'll read through the rest of the report. But that's kind of the way to screen for trouble, is see if there's anything unusual there. And then after that, I'll spend time on the company's website, try to figure out what they're doing, what their strategic edge might be. Try to make a mental model of where this business could be in 5 or 10 years. Is there something sustainable here?
And I guess for there, you're probably looking at a lot of company presentations usually.
Yeah, I mean, they're always too rosy, so you have to take everything with a grain of salt, but they're a good way to understand, like, if everything goes right, then what the presentation says will be golden.
And so really you're looking at the company website almost as a customer and trying to get a feel for how viable this company will be in coming years.
Yes, exactly. That's precisely it.
So, and then at that point, one thing you haven't mentioned is like financial statements. Obviously, those would have been in the annual report. And you mentioned after you read the risk factors, you read the rest of the report. When you're reading the rest of the annual report, what are some, I'm sure you read through all of it, but what are some big things that you think are most important for you to assess after the risk factors?
Biggest things. As far as the income statements and algo, I actually generally look at those through a site called Guru Focus, because it has the last 15 years. If you have a premium subscription there, you get the last 15 years of financial statements, all kind of in a nice Excel table. And so it makes it very easy to see long-term trends in the data. And so I actually see those through my data provider. But in the filings, you look for, like, who are their customers? What's their capital structure? Like, what loans do they have? What's their cash situation? Stuff like that.
Sure. So when it comes down to, you've looked through their annual reports, you've looked through the company website, you've gotten a good feel for who they are, what they do, and what their overall, I guess, health is at the moment. Do you have any filters you have in place before you buy? Like, what do you have to have before you push the button?
Yeah, that's a great question. I will try to find somebody who's bearish on the stock, assuming it's something I'm buying. I'll try to find somebody who's bearish just to see, like, is there something that smart people know that I might be missing? And so I'll look on Thinking Alpha and around the rest of the internet to see if there's any good reason why I shouldn't buy the stock. I'll also check the short interest of the stock. If the stock has high short interest, then oftentimes there's something that is wrong with the company that isn't clearly visible. If I can't find, like, if the company looks really good, like almost too good to be true, I'll also check out competitors in the industry and look through their filings just to see if, like, is this company doing something different from the rest of the industry that makes it kind of odd.
That's great. I'm taking notes. And so basically you run it through those filters, finding people who are bearish. Maybe you're missing something, checking short interest, because if there's a high short interest, there's probably some significant risk factor that maybe you haven't noticed. And then If the company is too good to be true, like it looks wonderful, figure out, okay, look at their competitors and see if maybe you missed something there as well, or maybe there's an alternate investment opportunity that you haven't seen, that you've missed.
Mm-hmm. Yeah, when I was working at the hedge fund, when we were looking at the Chinese companies that had all listed in the U.S., where a lot of them were fraudulent, we would always look at their competitors because their financial statements were often wrong. And one of the best ways to find that they were wrong was to look at their profit margins, because these companies were reporting much higher profitability than U.S. or European firms in the same industry. I remember looking at a copper recycling firm, which is an extremely commodity business. You just like take old wiring and melt it down and then sell new pipe out of it. And this Chinese company was claiming 25% profit margins. In the US, it's like a 5% margin business. And so I'm just looking at this. I'm like, that doesn't make any sense. And I was looking at the number of employees they had. And the company used far fewer employees per dollar of revenue than the US firms. I'm like, that doesn't make any sense. And so just the more I was looking at it, like, this company doesn't remotely resemble its competitors. So either it has some magical recycling technique, or they're overstating their numbers. It turned out to be a complete fraud.
Wow. Well, and it shows the value of doing a little bit of research, checking things around, and having a system. And I mean, I don't know if you have I doubt you have a checklist in front of you when you're doing this, but in your mind you do. And it helps to go through and check these boxes in our minds and figure out, okay, because if you could check all these boxes, you're not being irrational and you're not making an emotional investment. If you're checking them with integrity, you can, at the end of the day, say, you know what? There's always room. You could be wrong, but you've really done everything you can to investigate whether or not this is a great opportunity, and you believe it is at that point. So I always have a lot of respect for someone who has a clear system. So congrats on that, for whatever that's worth for you.
Thank you. I would recommend to listeners who are starting out in terms of valuing companies or deciding how to make their own portfolios. If you're getting started with corporate analysis, I would suggest focusing on one sector and getting to know really how the numbers work in that sector, like understand profit margins there, understand the competitive model, and just focus on one thing. And once you get a grasp on that, like you understand this is how everything works, and you could teach a class on it. Once you have a firm grasp of one industry, then I would recommend then spreading out to other industries. But there's so many different metrics and things that vary from industry to industry. And so I think one of the errors I see in a lot of younger or newer investors is they've learned a metric that's very useful in one area, and then they'll start studying something else. I see this all the time with banks, where people that use traditional metrics will start analyzing a bank and say, oh, this looks really cheap. But in banking, you have a totally different system. And so it's good to have a circle of competency and then slowly expand that.
Yeah. Well, like you could go to the produce section of a Target and be like, wow, these prices are great. They're so much cheaper than the produce section at Whole Foods. Like, well, there's a reason for that. It's not exactly the same thing. And the prices aren't always, it's less dollars, but maybe it's not necessarily cheaper, if that makes sense.
Yeah, exactly.
Yeah, that's great. Well, I think that's a good transition, because as we're wrapping things up, the whole interview has been full of great advice, and I thank you for that. Is there any other parting words of advice or wisdom you'd want to give to our listeners before we finish up?
I don't have anything on my mind. Do you have a last question for me? Is that it?
That was it. Yeah. No, but I think, like I said, I really appreciate how specific you've been, and a lot of the details throughout this just do a lot to have kind of fill in gaps for people and give some concrete structure for making decisions and getting into your mind what you do. So thank you so much for that, and thanks for the time with us today. Always good to be with you. Likewise. Thanks for having me. Well, I hope you enjoyed today's interview with Ian Bezek. Remember, you can get full show notes with links and other details at investorinthefamily.com. And don't forget the online investing conference. Go to onlineinvestingconference.com. That's onlineinvestingconference.com, and sign up now while it's still free up to September 7th. And you will get the highest conviction investments by Brett Jensen, Cody Willard, and others. And again, that will go live on September 12th. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.